Welcome to the online classroom for the module FIN2601. We've been going through the classes, and in the previous class, I gave you some homework to look at. In particular, I asked you to look at some past exam questions. So we are going to continue by looking at the solutions of those past exam questions that I asked you to look at. And we'll just discuss them, and then we'll start looking at study unit 6. Study unit 6 is known as share valuation, determining the price or the prices of shares. And once again, your calculator will be very, very important in helping you to understand and follow the concepts associated with share valuation. So we can start going through. So the first question I asked you to look at was from October, November 2019, number 31. The question says, a security has an expected return of 14%, and its beta is 1.45, and the expected return on the market is 11.5%. And then we are asked to determine what the risk-free rate is. So the moment you see items like beta, the return on the market, and the risk-free rate, originally you should think of the capital asset pricing model. And remember what the capital asset pricing model says. It says the required return is equal to the risk-free rate plus the beta on the share multiplied by, open bracket, the return on the market minus the risk-free rate. So we need to solve this equation. So how do we go about doing that? We substitute all the information that we've been given. We've been given the expected rate of return, which is 14%. We want to solve for the risk-free rate. We've been given beta, which is 1.45, and we've been given the return on the market. We want to solve for the risk-free rate. And then once we've done that, we remove the brackets. We say 1.45 multiplied by 11.5%, and we get 16.675%. And then we say 1.45 multiplied by RF, multiplied by minus RF, and we get minus 1.45 RF. We take this to the other side because we want to leave the RF values by themselves so that we can solve for RF. We take 16.675 to the other side, and then we say 14% minus 16.675, giving us minus 2.675, right? And then at the right-hand side of the equation, we get RF minus 1.45 RF. So we simply say 1 minus 1.45, and then that gives us minus 0.45 RF. And then lastly, we divide both sides by minus 0.45, minus 0.45. So we say minus 2.675% and minus 0.45. We divide both sides by minus 0.45. In other words, we say minus 2.675% over minus 0.45 is equal to minus 0.45% over minus 0.45%, right? So this is minus 0.45 R. So this cancels with this. And then if we divide these two, we get 5.94%. Okay, so it means the risk-free rate is 5.94%. So for this module, just like a lot of other modules, you need to be able to solve equations. You need to be able to solve equations such that when you've been given items in the capital asset pricing model, you need to be able to substitute all of those items onto the appropriate places and then solve for the particular variable you're looking for. Okay, so that's an important part. It's maths that you should know, right? The next part of the question, the next part of the homework, sorry, was June 2019. I asked you to look at number 29. This says you own a share portfolio invested 30% in share A and 70% in share T. The betas for these two shares are 1.5 and 0.6 respectively. What is the portfolio beta? So we've been given the betas for two shares, right? Including their weights, and we're asked to get the beta of the portfolio. It's a very simple one, this one. Remember the formula for the beta of a portfolio. We just take the beta of the first asset multiplied by the weight of the first asset in the portfolio, plus the beta of the second asset multiplied by the weight of the second asset in the portfolio. We add that up, and then we get 0.87, which is option 2. So fortunately for us in this question, the weights were already given. We were already given W1, which is 0.30, and we were given W2, which is 0.70. Okay. Then the next part, I also asked you to look at number 38 from the same paper, which is June 2019. We are told you want to own an asset with a real rate of interest of 1.3%, an inflation premium at 5%, and a risk premium at 1.2%. What is the nominal interest rate? Remember, our nominal interest rate is made up of 3 parts. Our nominal interest rate is made up of the real rate plus the inflation premium plus the risk premium. Okay, so our nominal rate, the nominal rate is made up of the real rate plus the inflation premium plus the risk premium. So we've been given the real rate as 1.3%. We've been given the inflation premium as 5%, and we've been given the risk premium as 1.2%. And if we add those up, we get 5 plus 1.2, which is 6.2, plus 1.3, giving us 7.5. So that would be the nominal rate. Okay, and then now section B. Section B had some long questions. I think it's still the same paper, October, November. Sorry, is it June 2019? Let me just see if I can open that paper and we can go through those questions just to help you to better understand the concepts that we're looking at. So ideally, I hope you practiced those questions. So we just want to go through to see if what you did as homework will be similar to what I take you through. It's always important to go through these questions so that you become more familiar with them and your understanding of the concepts is cemented. Let me see, are we looking at October, November? Or, yeah, this is the paper with Bavaria and Harbin. Is that it? Bavaria Beer and Harbin, yes, okay. So there is the question. So the first question said, you are interested. So this was the setup of old question papers. In old question papers, you would have 2 sections in the exam. You would have section A, which consisted of multiple choice questions. And then you would have section B, which consisted of long questions. Okay, so I still believe we can use these long questions as practice. We can use both the multiple choice and long questions as practice. And I think this long question that we'll look at will also be important in helping you in this module. So we'll look at this question. It's worth a lot of marks, 15 marks. So we'll just look at that question, explain the concepts, and then we'll move on to share valuation, determining the prices of shares, a very important topic. Okay, so you are interested in buying ordinary shares in the Bavaria Beer Company and Harbin Beer Company. These companies produce premium beer sold in upmarket clubs across South Africa. You attach the following probabilities to possible states of the economy using your insights to the local economy and demand for premium beer. So we have a summary of information we've been given here. We've been given states of the economy. We've got 1, 2, 3, 4, 5 states of the economy. We've been given the probability of a particular state occurring, 10% chance that we have a very deep recession, 20% chance we have a mild recession, 40% chance normal growth, 20% chance strong growth, 10% chance exceptional growth. We've been given the anticipated rate of return on Bavaria Beer Company if this state occurs. So we get a minus 15% return on Bavaria if there's a very deep recession, a 3% return on Harbin Beer Company if there's a very deep recession, 0% return if there's a mild recession under Bavaria Beer, 7% return under Harbin Beer if we have a mild recession, 5% return if we have normal growth, 11% if we have normal growth under Harbin Beer, 15%, 20%, 10%, 25%, all corresponding to particular states of the economy. And then we are asked to perform a number of questions, and you're also asked to show your calculations. Firstly, calculate the expected return for each company. So we have to calculate the expected return for Bavaria Beer Company and Harbin Beer Company. And then we also have to calculate the standard deviation for each company for Bavaria Beer Company and Harbin Beer Company. And then lastly, we have to calculate the coefficient of variation for each company for Bavaria Beer Company and Harbin Beer Company. And then if you could invest in only one of these two companies, which one would you select? Explain your answer. So the key here is to just make sure you get your formulas right and you use your calculator correctly to enter in these particular values. If you have good calculator technique, it shouldn't be too difficult to do these calculations, right? We're simply multiplying each probability times the corresponding expected return under each state of the economy, and then we add the values up. So maybe what I can do, just to help you to understand, I can put a calculator up on the screen, and I can enter those values. And you can see how in particular we would go about doing this calculation just for Bavaria. I'll just do it for Bavaria as an illustration to show you how we would go about entering these values into our calculator, just to give you a bit of an understanding on those concepts. It's really important. Okay, there we go. Sorry about that. So we can clear the calculator. So the key here, when you're entering expected returns, the key is to put, when you want to calculate expected returns, the key is to put returns as percentages, not as decimals, and probabilities as decimals, right? So for Bavaria, we would say open bracket, Then we look for this minus, not this one. For some calculators, you have to go where there's a plus minus. For some calculators, you have to go where there's a plus minus button. And then you need to press a plus minus button to get the minus, right? So we say minus 15 multiplied by 0.10, close bracket, plus, open bracket, 0 multiplied by, so it's 0% multiplied by 0.20, right? Close bracket, plus 5% being the return, the next return, multiplied by its corresponding probability, 0.40, close bracket, plus, open bracket, 10 multiplied by 0.20 being the probability, plus 25% multiplied by 0.10, close bracket. And then if you calculate that, you get 5%. So you'll see that's how we got this 5%. And you would repeat the same for Harbin, and you would get 11%. You can just practice that. So those are the expected returns. And then you can calculate the standard deviations using the following formula. There are two formulas to calculate the standard deviation. Remember, we talked about that in the earlier classes. But preferably, you can use this formula right here, right? Where you take your returns and you square them, and you multiply them by the corresponding probability, and you keep adding them up, right, for all possible states, all probabilities, and the corresponding returns. Then you subtract that expected return that we got earlier, right, squared. And then the answer you get under the square root sign, this particular calculation under the square root sign, which gives us 90, that is the variance. And then the square root of the variance would be the standard deviation, which is what we are looking for, right? So again, just for one of these companies, in particular for Bavaria, I'm going to show you how to enter all these values into your calculator and how you would go about doing the calculation, just for practice to help you to understand. So I'm going to take Bavaria, enter in all these values into that calculator I'll have on the screen, just to help you. And then you can also practice with Harbin to see if you can get the same standard deviation. Okay, so let's do that. Let's go to the calculator. Again, always remember to clear your calculator. And then now we enter the values. Remember, open bracket, minus 15, close bracket, squared. You see there'll be an X squared button on most calculators, so you can press that one to square. And then with some calculators, you then have to press right just to go down from the top. You see if you're at the top there with the 2, you just have to press this button to go down. Okay. And then times the corresponding probability there is 0.10 plus, open bracket, 0% return there. And then with some calculators, you need to press this button. With others, like mine on the screen, it just goes down, multiplied by the corresponding probability, which is 0.20, plus, open bracket, 5% squared, times the corresponding probability, which is 0.40, plus, open bracket, 10% squared, multiplied by the corresponding probability, which is 0.20, plus, open bracket, 25 squared, multiplied by the corresponding probability, which is 0.10, minus the expected return, which is 5% squared, right? And then we get 90. So this is the variance. And then if we say the square, sorry, so that's the variance, right? And then we can clear, then we can say square root of that variance of 90, and then we get our standard deviation, which is 9.5, 9.4886, which is 9.5. So you repeat that for Harbin. You can also just repeat that for practice, and you should get 4.57. And then we can calculate the coefficient of variation for both Bavaria and Harbin, which is simply the standard deviation divided by the expected return for each of them. We get the coefficient of variation. And then remember, we should always select the option with the lower coefficient of variation, because it means that that particular share has less, it's got less risk per unit return. So if you are a risk-averse investor, you'll be attracted to shares with a lower coefficient of variation. So in this case, we would select Harbin Beer. Okay. So I hope you practice through that and you now understand how to do calculations involving expected returns and standard deviations and coefficients of variations. Right, so we now want to look at the final study unit in the module, share valuation, right? We've covered financial statement analysis, time value of money, risk and return, interest rates, and bond valuation. So we now want to look at share valuation. And we're going to look at share valuation in two classes. In this class, I'll take you through part one of share valuation, what it's about, how to do some basic calculations and everything associated with it. And then in the second class, I will take you through part two of share valuation. Okay, so let's look at this. So I'll just read through and I'll be explaining this very important topic on share valuation. Remember, a company can raise finance from two sources. They can raise finance from bonds and they can raise finance from shares, right? Bonds, it means that the company has a loan, they've borrowed money. Whereas shares, when a company raises money through shares, shareholders effectively are the owners of the company. So shares are sort of like the company selling, they are sort of like the company selling parts of their holdings, part of their ownership to shareholders. Okay, so bonds involve borrowing money, whereas to borrowing money from lenders, whereas shares actually mean that the company raises money, but whoever puts money into the company through shares effectively becomes part of the owners of the company, right? So sometimes if a company doesn't want to dilute ownership, they would rather borrow, because if you raise money through shares, it's like you're diluting ownership of the company, because you're getting more and more people owning part of the company. So I'm just going to talk about that again, differentiating between debt and equity. So like I said, equity represents ownership. This is very important. Equity represents ownership in the company, right? So shareholders in the form of ordinary shares are the owners of the company. So if you have shares in a particular company, you are an owner of the company. Whereas if you loaned money to a company, you're not an owner, you are just a lender to the company. So these equity holders, these shareholders we're talking about, can be divided into two groups. We have preference shareholders and we have ordinary shareholders, right? And ordinary shareholders are the owners of the company. Preference shareholders, they do fall under equity, but they are not the owners of the company. Ordinary shareholders are the owners of the company. So equity can be divided into two parts. It can be divided into preference shares and ordinary shares, but ordinary shareholders are the owners of the company. So here there are just some explanations about ordinary shares, which are also known as common stock, right? Ordinary shares are also known as common stock or common shares. And then we also have preferred stock, which are also known as preference shares, right? So there's just some theory explaining the difference between ordinary shares and preference shares, and it's important to know these differences. Okay, you can just read through, like I said before, common stock ordinary shareholders, these are the true owners of the corporate business. Common stockholders are also referred to as residual owners because they receive what is left, the residual, after all other claims of the firm's incomes and assets have been satisfied. Remember, if a company goes bankrupt, lenders get paid first, followed by preference shareholders, and finally common stockholders, ordinary shareholders. So we are also told, as a result of this generally uncertain position, common stockholders are expected to be compensated with adequate dividends and ultimately capital gains. So ordinary shareholders will receive dividends regularly, which are a share of their profits from investing in a company. And then on the other side, we have preference shareholders. And then preferred stocks give its holders certain privileges that make them senior to common share stockholders. Remember, preference shareholders are promised a fixed dividend, regardless of whether the company makes profits or not. And the dividends are calculated based on what we call a par value. So a preference share is a special type of share in which the preference shareholders will receive a fixed dividend, regardless of whether the company is making profits or not. There are special types of preference shares, different types, but we won't go deep into distinguishing between them. You touch upon different types of preference shares if you keep studying financial management, but for now you just have to know that preference shareholders, they pay a fixed dividend regardless of whether the company is making profits or not, whereas ordinary shareholders, the dividends are at the discretion or are up to the decision of the board of directors. If the board of directors decides not to pay dividends to ordinary shareholders, there's nothing ordinary shareholders can do. The decision is up to the board of directors. However, with preference shares, you will always get a fixed dividend regardless. So now that you understand the different types of equity that we have, you can also read up more on them. You now have to be able to actually determine the price. You have to be able to calculate the price of an ordinary share, the price of common stock, and also the price of preferred stock of a preference share. Okay, so there are certain models that we can use to determine the price of a share. And the basic idea behind these models is that the price of a share is equal to the present value of all the dividends expected from the share and any other cash flows associated with the share. For example, receipts when selling the share. Okay, so what do I mean by that? Let's say I own an ordinary share in ABC Limited. Let's say I own an ordinary share in ABC Limited. And let's say I am here today at time 0. And let's say I expect to hold the share for 3 years. And let's say after 1 year, I expect to receive a dividend of 3 Rand. After 2 years, I expect to receive a dividend of 4 Rand. And then after 3 years, I expect to receive a dividend of 5 Rand. And then I'm going to I anticipate that I'm going to sell the share for 30 Rand. This is an anticipation given market conditions. What this statement is saying, the price of this share, is just equal to the present value of this 3 rand plus the present value of this 4 rand plus the present value of this 35 rand. The present value of this 35 rand. In other words, if we want to determine the price of a share, we simply need to find the present value of all the dividends that we expect to receive from the share, and also any other cash flows that we expect to receive from the share, and then we add them up. So to determine the price of a share, we simply take the present value of all the expected dividends we expect to receive from the share, as well as the present value of any other cash flows associated with the share. For example, if we anticipate that the share will have a certain price sometime in the future. So that's the basic thing we're going to be doing when we look at calculations involving the price of either an ordinary share or preference shares, right? So it's also important to note that the price that we calculate, the price that we're going to be calculating using these models, it's known as the intrinsic value. It's known as the intrinsic value of the share. The price that we're going to be calculating with the models that we're going to be using is known as the intrinsic value of the share. So in an efficient market, the price that we calculate, known as the intrinsic value, should be equal to the market price. Okay, so what do I mean by that? We might sit down and then we might say, okay, let's try to calculate the price of, let's say, MTN, right? Let's say we want to calculate the price of MTN. We might do calculations on the price of MTN, and then we might see that the price of MTN, based on our calculations, is 350 Rand. We call that the intrinsic value of MTN. That's the intrinsic value of MTN. However, we might go to the Johannesburg Stock Exchange where you can buy or sell shares from MTN. And then you might find that at the Johannesburg Stock Exchange, the actual price of MTN on the market where there are buyers and sellers, you might find that the price is actually 400 Rand. So you see the intrinsic value that we calculated might be different from the market price that you observe in the market where people can buy and sell shares. So whenever that happens, we say that a share is not priced fairly or correctly. When what we calculate is not equal to what's on the market, we say that the share is not priced fairly or correctly. However, if what we calculate, let's say we calculate 350, and then we go to the Johannesburg Stock Exchange where people buy and sell shares in listed companies in South Africa, and we find that the price is also 350, then we say that the share is priced correctly or fairly priced. Okay, so that's important. So there's a special theory known as the efficient market hypothesis, which states that if the intrinsic value is equal to the market price, the share is priced fairly, and that the theory says in an efficient market, the price that we calculate should always be equal to the market price. If the market is efficient, the price that we calculated should be equal to the market price. But that's not always the case. There's always the case that when analysts sit down and they use their models, they might find that their projection of what the price of a share should be is actually different from the market price. So this efficient market hypothesis, it's a theory. It holds in some markets, whilst it doesn't hold in other markets. But If a market is efficient, in an efficient market, investors would buy an asset if its expected return exceeds the current return, thereby increasing its market price and decreasing expected return until expected and required returns are equal. I'm going to explain this, don't worry. According to the efficient market hypothesis, share prices are in equilibrium, fairly priced with expected returns equal to required returns. Share prices fully reflect all available public information and will react quickly to new information. Investors should therefore not waste time searching for mispriced, overvalued, or undervalued shares. Okay, so now I just want to explain this theory. It's some important finance and investments that you need to note. Basically, what this is saying that if the market or the economy of a country is efficient, right? If the financial markets of a country are efficient, it means the intrinsic value, which is the value we would calculate using our model, it should be equal to the market price, right? In other words, share prices are in equilibrium. Our shares are always fairly priced, and our shares always fully reflect all the information available to the public. We calculate the intrinsic value based on information available to the public. Everyone else in the market has that information, and that means the market price is equal to the intrinsic value. It means we shouldn't waste our time trying to determine if a share is too expensive or too cheap, meaning that the intrinsic value is not equal to the market price. Okay, but that's not the case. When we say that a share is mispriced, meaning it's overvalued or undervalued, it means that the intrinsic value is not equal to the market price. However, this theory known as the efficient market hypothesis says if the market, the financial market we buy and sell shares in is efficient, then the value of a share that we calculate, known as the intrinsic value, should be equal to the market price of the share, because everyone has the same information and they price the share correctly. And in an efficient market, what would happen is that if people view a share favorably, and they gauge that the expected return on the share is more than the current return that the share is giving, right? This would increase the price. In other words, people would demand the share more. They would start buying that share more and more because they see that this share is attractive compared to the current returns it's offering. We expect, for example, maybe this share might be currently paying a dividend of 3 Rand, but you might expect that the share is going to start paying a dividend of 5 Rand. So you might then say, let me rather purchase this share in anticipation for this higher dividend. And then what that will do, that will increase demand. More people will start buying that share. And then because the price of the share will go up, it means that your expected return will go down. It means that you'll actually have to use more money to purchase the share to get this 5 Rand, and then it will cancel out the 2 Rand dividend. The 2 Rand difference you were looking to profit on, the difference between 3 and 5 Rand. And this will keep happening in an efficient market. If a share is attractive, people will buy it, forcing the price up, and that erases any benefits associated with the gain. And if a share is unattractive, people will sell it, forcing the price down, removing any negative perceptions associated with the share. It's more something covered in investments rather than finance. So don't worry too much about that for finance. But if you're doing investment modules like FIN2601, those are some important concepts you should be familiar with. Okay. I'll be looking at doing some classes on FIN2601 soon, and you'll be able to find them on the website on the screen if you just really want to understand investments and their importance. Okay, so INV2601 is the sister module to FIN2601. Okay, so that intrinsic value, so the market price is simple, right? If we want to determine the market price of a share, we can just go to the Johannesburg Stock Exchange, or the prices are listed, right? Companies list on the stock exchange. Investors can buy shares in a company, they can sell shares in the company. The market price is easy to get. However, how do we get the intrinsic value of a share? How do we get the intrinsic value of a share so that we can compare it with the market price to decide if a share is fairly priced or not? So there are three very important models you need to know for FIN2601 when it comes to determining the intrinsic value of a share. There's the zero growth model, also known as the no growth model. There's the constant growth model, also known as the Gordon growth model. And there's the variable growth model, also known as the multiple stages of growth model. So these are just three types of models that you can use. If you go on and study finance and investments later, like at third year and honors, you'll find that we can extend these models and study them further. But for the purposes of FIN2601, we have three models that we can use to determine the intrinsic value of a share. And in simple terms, the zero growth model assumes that your dividends do not grow, or they grow at 0%, meaning they don't grow. The constant growth model means that your dividends are growing at a constant rate, at a certain fixed percentage growth rate, whereas the variable growth model assumes that your dividends are growing at different rates, right, over different time intervals into the future. So we're going to finish off the class by looking at some examples associated with the zero growth model, the constant growth model, and the variable growth model. So the zero growth model. So we use this model to determine the intrinsic value of a share if the dividends of the company, or if the dividends of a particular share in the company are expected to remain the same into the foreseeable future, and they will not grow. We also use this model to determine the price of a preference share. So if a company is paying dividends, and these dividends are expected to remain the same, right? The dividend paid today is going to be the same as the one paid after 1 year. That's D1 dividend in 1 year. It's going to be the same as the one paid in the second year, the third year, the sixth year, into the future, right? So we are assuming that dividends remain the same forever. They are not changing. A company paid a 2 Rand dividend today or last year, they'll pay 2 Rand next year, 2 Rand second year, 2 Rand. So they're just paying a fixed dividend forever into perpetuity. If that's the case, we can determine the price of the share by simply taking that dividend over the required return. D is the fixed dividend and R is the required return. So we can just simply divide the dividend over the required return, and then we can get the intrinsic value of the share. So here's a very simple example. A company has a required return of 9% and a fixed dividend of 2 Rand, which we anticipate they'll pay 2 Rand forever. Determine the price of the share. We simply take the dividend of 2 divided by 0.09, which is 9%, and we get 22.22 Rand. Right? Here's another example. A bank is expected to pay an annual dividend of 90 cents per share indefinitely, and the required rate of return is equals to 18%. Determine the value of the share. We simply take the dividend over the required return, 0.9 over 0.18, and we get 5 Rand. So this is the value of the share. And then we can also apply the same when it comes to a preference share. Remember, with the preference share, we have what we call a par value associated with the preference share. And you'll usually have some percentage given before the preference share, And this percentage is the percentage associated with the dividend. So you might get a question which says a 10%, 120 Rand par value preference share has a required return of 13%. Determine the value of the preference share. So remember, a preference share pays a fixed dividend, right? A preference share pays a fixed dividend. So what we would do, we would start by determining the fixed dividend associated with the preference share. We would simply take the percentage of the preference share, multiply that with the par value of 120 Rand, and we get 12 Rand. And then we would simply take that 12 Rand dividend divided by our required return of 13%, and then that would give us the price of the preference share. Okay. So also look out for preference shares. If you get a preference share, immediately think about the no growth or zero growth model in terms of determining prices or required returns and so forth. And then we also have the constant growth model. Now, the constant growth model is very, very important. It's another model that we can use to determine the price of a share. However, we use this model if dividends are expected to grow at a constant rate forever. Whereas with the zero growth model, we were assuming that our dividends are not growing, they are remaining fixed, right, forever. With the constant growth model, we are assuming that our dividends are growing at a constant rate forever. So maybe we might be assuming our dividends are growing at 5% or 4% or 7% forever. So this model also has a special name. It's also known as the Gordon growth model. So we would use this model, for example, if dividends are expected to grow at 5% forever, right? If we expect our dividends to grow at a fixed percentage forever, so we can determine the price of the share using the following formula. If we assume that our dividends are growing at a constant rate forever, we can use either this formula if we've been given the expected dividend at the end of year one, or we can use this formula if we've been given the current dividend or the most recent dividend, right? So the price of our share today is equals to the expected dividend over the required return minus the growth rate, if we've been given the expected dividend, or the price of our share is equal to the current dividend multiplied by 1 plus growth over the required return minus the growth rate, right? If we've been given the current dividend. So this model is very important. You need to check carefully whether you've been given the expected dividend or the current dividend. If you've been given the expected dividend, you just divide by the required return minus growth. But if you've been given the current dividend or the recent dividend, you have to take that current or recent dividend, which is D0, multiply it by 1 plus G. This changes it to D1, which is an expected dividend, and then you divide by R minus G. But we'll look at that as we touch on examples. So we can look at 2 examples just to illustrate this. So yeah, I'm just introducing this to you with some simple examples. The first example says the dividend on a share is an expected growth rate of 10%, a required rate of return of 15% on the share. The current dividend is 3 Rand. Determine the price of the share. So here we've been given the current dividend. So that's D0. That's the most important part with regards to determining the price of a share when you have a constant growth rate. So we would take D0, which is our current dividend, multiplied by 1 plus growth over the required return minus growth. And then the current dividend multiplied by 1 plus growth, we get 3.3. Our required return minus growth, we get 0.05. 3.30 divided by 0.05, we get 66 Rand. So the price of our share would be 66 Rand, right? But look at that example that we just did, where we had the current or the recent dividend compared to when we have the expected dividend, right? Expected dividend. So the constant rate of dividend growth for RA investments is 8%, right? The firm is expected to pay an annual dividend of R2.50 next year. The required rate of return is 18%, determine the value of the share. So now we have D1 rather than D0. D1 is 2.5. Our required return is 18%, and our growth rate is 8%. So now we have D1. We don't have to multiply by 1 plus G. So when we had the current dividend or the recent dividend, we had to multiply by 1 plus G. However, when we have the expected dividend or the dividend to be paid next year, we don't have to multiply. We just take D1 over R minus G. We get 2.5 over 0.1, giving us 25 Rand. Okay, so that's important. We're going to look at how these questions can also be asked differently in the next class. But yeah, I'm just introducing you to the basics. And then lastly, with the variable growth model, the model is used to value shares with dividends that exhibit at least 2 cycles of growth. So with the variable growth model, rather than having no growth forever or a fixed growth forever, you have different growth rates. Maybe for the first 2 years, it will be no growth. Then for the next 5 years, it will be 3% growth. Then for the next 3 years, it will be 7% growth. So you now have different growth rates applying over a different number of years before the dividends settle off to a constant growth rate forever. Okay, so I've described it in words, but we're going to look at a question to illustrate what we mean. So the basic idea here is that our growth rates are variable. We don't have a fixed growth rate. Rather, we have different growth rates over different time intervals going into the future. So the pattern of dividend growth will differ from scenario to scenario, and it's important to read the question carefully to identify the scenario. So for example, this is just an example. You might be told that there'll be 5% growth for the first 2 years. Okay, let's say our current dividend maybe is 7 Rand. Then you might be told for the next 2 years, this 7 Rand dividend will grow by 5%. Then it will grow at 0% for the next 3 years after those 2 years. Then it will grow at 6% for the next 4 years after those 3 years. And then finally, it will settle at 8% forever into perpetuity. So you see there's a mixture here. There are different growth rates before settling at a constant growth rate into perpetuity into the future. So what are the steps when it comes to determining the price of a share using the variable growth model? Okay, so the steps are as follows. We're going to use these steps to look at an example. The first step, you need to determine all the expected future dividends, and I'm going to show you how to do that. Then next, you need to determine the price of the share in the year before the last dividend. And then you need to determine the present value of all the future dividends except the last dividend and the current dividend. Then you need to determine the present value of the price of the share in the year before the last dividend. And lastly, you need to add the answers in part 3 and 4 to get the price of the share. So these are the steps. Determine the expected future dividends. Determine the price of the share in the year before the last dividends. Determine the present value of the future dividends except the last dividend and the current dividend, D0. Determine the present value of the price of the share in the year before the last dividend. And lastly, add the answers in parts 3 and 4 to get the price of the share. So let's actually do that. Let's look at an example as we finish off this class, first part on share valuation. The current dividend on a share is 3 Rand. So current dividend. The moment you see current dividend, you know you've got your D0. That's important. Okay. So the current dividend on a share is 3 Rand. Dividends are expected to grow at a rate of 5% for the next 2 years, 7% for the third year, 8% for the next 3 years, before it settles at 4% forever thereafter. So you notice we have different growth rates, variable growth rates, they are not fixed. If the required return is 10%, determine the price of this should say share, determine the price of the share. I'll fix this. It shouldn't say year, it should say share, determine the price of the share. Okay. How do we go about that? So in other words, determine the intrinsic value of the share. Step 1, remember step 1 says determine the expected future dividends. Determine the expected future dividends. So we'll start with step 1. Okay, so to determine the expected future dividends, we start with D0, which is the current dividend, which is 3. And then we say D1 is equal to D0, which is the current dividend, multiplied by 1 plus 0.05. Remember, we were told that it's going to be 5% growth for the first 2 years. So to get the dividend at the end of year 1, we take the current dividend, D0, multiplied by 1 plus 0.05 to give us D1, right? That's the expected dividend at the end of year 1. Then to get the expected dividend at the end of year 2, we take D1, which is the expected dividend at the end of year 1, multiplied by 1 plus 5% again, because we are growing at 5% for the first 2 years. Then we get 3.3075. So that's D2. And then to get D3, we take the answer we got here for D2 and we multiply it by 1 plus 0.07. Because we were told, if you remember, we were told that it will be 5% for the next 2 years and then 7% for the third year. For D3, we're going to take the D2 dividend, multiply it by 1 plus 0.07, which is 7% growth to give us D3. And then after that, we were told it will be 8% for the next 3 years. So to get D4, we can then take D3 multiplied by 1 plus the growth rate, which is 8% for the next 3 years. And then we get 3.8221, right, which is D4. Then we can take D4 multiplied by 1 plus 8% to give us D5, which is 4.1729. And then it's for 3 years, we can take D5 multiplied by 1 plus 0.08 to give us D6. So for the next 3 years, 8%, 8%, 8%, we get D6, which is 4.4581, right? And then lastly, we are told the rate will settle at 4% forever thereafter. So we say 4.4581, that's D7, the final one, multiplied by 1 plus 0.04, giving us 4.6364. So that's the first step, determine the expected future dividends. Then the second step, determine the price of the share in the year before the last dividend. So remember, the last dividend is D7, right? So what we do, we determine the dividend, the last dividend is D7. We determine the price of the share at times 6 in the year before the last dividend. So the price at times 6 is just going to be the dividend at times 7, which is the next dividend, over the required return minus the growth rate. So the price at time 6, the price in the year before the last dividend will simply be D7, which is the next dividend over the required return minus the growth rate. And then we substitute that information into our formula D7 over our required return minus this final growth rate. We use the final growth rate here. That's very important, which is 0.04. And then we get 77.27. And then step 3, determine the present value of all the future dividends except the last dividend and the current dividend. So we then use our financial calculator to determine the present value of all these dividends, except the first dividend, and the last dividend. So in other words, what we're doing here, like what I told you right at the beginning, we're simply taking D1, D2, D3, D4, D5, D6, and P6. These are all the price at time 6. These are all future expected dividends and the price we anticipate we can sell the share at after year 6. So remember when I told you, when I said the price of the share is simply finding the present value of all these dividends, right? Including that price at time 6. We're finding the present value of all these dividends and this final price. We're finding the present value of all those dividends and this final price. And then the sum of all those dividends and the price at time 6, the sum of all those expected future cash flows will give us the price of the share today. Like I discussed that right at the beginning when I said that the price of a share, remember I gave you the description here, right here, when I said the basic idea behind these models is that the price of a share is equal to the present value of all the dividends expected from the share and any other cash flows associated with the share. For example, receipts when selling the share. So that's the idea behind the variable growth model. You're just determining all the expected future dividends you expect to get, the final price associated with the share at some time in the future, and then you find the present value of all the expected future dividends, except the first dividend, D0, and the last dividend, D7. Remember, we don't include D7 because we used D7 to calculate the price at time 6. So if you use your financial calculator to discount these, you get 15.97. And then step 4 says determine the present value of the price of the share in the year before the last dividend. This is a price at time 6. We need to bring it back to the price today at time 0. So we take this price of 77.27 as the price at time 6. 6 is the number of years. 10% is our required return. And then we get the price of 43.62. So we've brought back all these dividends back to today to a price of 15.97. And we've brought this share price, which is in the future, at time 6 back to today to give us 43.62. And then lastly, to get the price of the share, we simply add the present value of that price at time 6, which is 43.62, plus the present value of our dividends of 15.97. And then we get 59 Rand and 59 cents as the price of the share. So that's the final step, which is part 5. Okay. So please go through the class. If you really didn't follow anything there, go through it slowly, see if it makes sense, just revisit all the concepts we were covering. And then in the next class, I will take you through some random examples on share valuation. It will be a very short class. Just showing you different types of examples on how share valuation can be asked, just so you're prepared for that for the exam, okay? But for now, I think the class is done. We covered a lot, an introduction on share valuation. Thank you very much for listening. If you have any questions or queries with regards to anything covered, or if you would like to just enroll for more courses, please visit the website. You'll find assignment solutions for different modules, different discussions. There's a lot of resources to help you with your studies. You can email me. You can visit our website. The phone number is on the screen. Thank you very much for listening. I hope the class has been helpful. And all the best with your studies.